Um, I gave you a little bit of insight yesterday into the closing real estate transactions section and how arguably it used to be like a very long taught section, but I don't think it was necessary to teach to that extent because there's really only two styles of questions that can come from this section. Understanding the basics of a real estate transaction, meaning what would happen first, then what would happen second, then what would happen third, and how it kind of wraps up. And then, of course, understanding a closing disclosure. That's it. Those are the only two really testable pieces from the closing a real estate transaction section. And so I'm going to move through this section pretty rapidly because it doesn't really dictate spending a whole lot of time, at least not on the non-math part. So let me give you the basic rundown of a real estate transaction, folks. And I'll give you the rundown. Donna, the two styles of questions. Yeah, so the two styles of questions that could come from this are what would be some things that we'd be potentially doing in a transaction as real estate brokers, and understanding the closing disclosure, aka the math for a settlement statement or closing disclosure. And when I say settlement statement, that's just a generic name. The closing disclosure is the technical one that is required per RESPA that we kind of got into a little bit yesterday. So when we're talking about real estate transactions, folks, let me just give you a rundown of what a typical, we'll say, buyer agency transaction looks like, okay? In today's day and age, when we find potential buyers who are interested in purchasing a home, we will, of course, review the working with the real estate agent's disclosure with them so they understand agency. We will form an agency relationship with them so we can be their buyer agent and represent them. We will help them talk to a lender and get pre-approved so they know how much house they can afford, and so they're ready to put in an offer. And then we'll help them identify houses that would be a potential good fit for them. And we will schedule showings through a program called Showing Time, and we take them to go see these houses. And after we take them to several and they find one that they like, we would help them put in an offer. And we talked about it briefly early on, but we'll talk about it in more detail in future sections. When putting them an offer, we would assist them by putting together a CMA. I told you that stands for a comparative market analysis. And we would use that as a basis of, understanding what would be a reasonable offer price for this home that's listed. We're not just going to go off the list price because sometimes they're listed too low, sometimes they're listed too high. And so we want to make our own kind of assessment. And once we submit an offer, folks, and really before we submit the offer, one of the big things we're going to do is we're going to talk to them about potential red flags. Right, we talked about that in the agency section. Red flags are a big part of our industry. So as we're walking through the house, I'm going to point out, what looks like maybe standing water, looks like water damage, that looks like an electrical issue, that looks like, something's not functioning properly. And that way we can make good decisions on how much of any due diligence money we want to offer, what type of due diligence period we're going to ask for, what issues may arise if we get under contract. Of course, other things that we would potentially want to review, restrictive covenants and zoning to make sure that they can use this property as they see fit. And then once we get it under contract, that starts the due diligence period. And we talked about the due diligence period in great detail in the sales contract section, which is that period of time for the buyer to investigate the property to decide whether they want to move forward with the purchase or not. And things that we have during that period of time: home inspections, pest inspections, well inspections, septic inspections, sometimes secondary things like structural engineers. And so we identify anything and everything of concern to the best of our ability by ordering these inspections. We, as the real estate brokers, are typically the ones ordering these inspections. We suggest them, and if our clients want them, we will order them for them. And then we'll take all the information that we get and we will use that potentially in a secondary set of negotiations to ask for repairs on the property, credits, adjustments in price, anything like that. And remember the way that the 2T works. The seller is not obligated to make repairs, but if we negotiate and they agree to it, they may be making some, and there's different ways they could negotiate those repairs. And so there's a lot of different phases and pieces of a real estate transaction. And so after the due diligence period has ended, then we are looking at what we call after due diligence leading up to closing section. And what that would involve is making sure that any negotiated repairs were completed, making sure that they get the clear to close from the lender because they got all their paperwork to the lender, that the any amendments or changes to the contract get sent to the attorney, and then ultimately making sure that we get to closing and the funds are submitted and the title work is done. And then they record it in the new name of the buyer. And then and only then would we we get paid thereafter. So there's a lot of kind of flow through in the way that a real estate transaction works. It's a lot more than what people realize because they just see what's fake on TV, like with HGTV and stuff like that. So a lot of different pieces in this helping them purchase a house. So what kind of questions would you get, folks? Questions like, what might a listing agent want to do with a seller when listing a property? Identify all the fixtures clearly that are going to convey or not going to convey in any personal property that is or is not going to convey. What is the buyer's agent potentially going to do? Order home inspections on behalf of the buyer for any inspections that they want to order. A lot of different things that could come into play. And if you have a basic understanding, a lot of these things you could kind of come up with. So a couple big testable items in here we'll get to in a second, but most of it's kind of like generic or general in that sense of just kind of understanding how it moves from contract to closing from both the listing side and the buyer agent side. And so things that we talk about providing to the settlement agent. By the way, we talked about this. The North Carolina settlement agent is typically an attorney. We said a non-attorney settlement agent could do certain things like instruct parties where to sign and collect and disperse monies. But it's typically handled by an attorney in North Carolina. And so attorneys would need the total contract, any copies of any addenda that were part of a contract, any amendments that were made to the contract. Of course, they need the contact information for both the buyer and the seller so that they can do the title work. They can order loan payoffs from the lender of any. Of course, getting copies of surveys. If a survey was ordered, remember we said they're not legally required to be ordered, but they're a good idea to identify any potential encroachments, easements, floodplains, title defects, things of that nature. Of course, the attorney, too, is going to work hand in hand with the buyer's lender to ensure that, all the loan paperwork is filled out and, the loan gets funded. Of course, the insurance, folks, the buyers get to pick their own insurance company. That's what we call a service the borrower can shop for. And so what they would do is they would just call up the insurance company they want to use, get a quote, and then they would have all that information sent to the attorney so that they can get the insurance policy in place. Now, the second to last one here says copies of any required inspection reports. Yeah, required meaning like for the loan. So we talked about this yesterday in the financing section. Pest inspections are required for VA loans. So they would have to make sure that there was a copy of that pest inspection in the file for the loan to get funded. The rest of the inspections, the attorney, the settlement agent wouldn't need because they're not required, but they are a good idea. And so if any of the invoices were being paid at closing, we would make sure that we give them the copy of the invoice so that they can get it paid, but they don't need the documents otherwise. So I've already talked about this. When we say the settlement meeting, that is the meeting where all parties go to sign the documents. That doesn't mean the transaction is done. The transaction is not done until the deed has been recorded. And so we refer to that as closed. It's not closed until the deed has been recorded. And that's why we kind of said it was kind of funny in the deed section. We talked about it and we said, oh, well, it doesn't have to be recorded. Well, yeah, but in North Carolina, we don't consider you the owner until the deed has been recorded in your name. And nobody gets paid until that deed has been recorded. Now, as I said, I'm not going to spend a lot of time on each individual slide because we've really already talked about this. This is just rehashing things that would be appropriate to look at, assess for the due diligence period. Making sure they can get adequate insurance, making sure that their loan comes back, making sure that they have a home inspection, pest inspection, septic, whatever they feel is necessary to feel comfortable that they want to move forward with the property. Now, one of the other things I've already taught you is on the next slide, and it goes hand in hand with this insurance piece. When we looked at the offer to purchase and contract, standard form 2T, we said that possession typically happens once the deed has been recorded, which means the buyers don't get the keys until the final deed has been recorded and the transaction is closed. However, we told you that there is a potential to negotiate a buyer possession before closing agreement and or a seller possession after closing agreement. And the biggest, most testable pieces of understanding that is that we would need to make sure that the adequate insurance was in place, a renter's policy being in place for whoever is acting as a tenant. If the buyer moves in before closing, they're the tenant, they need a renter's insurance policy. If the seller stays in after closing, they're the tenant, they need a renter's insurance policy. Other things to arguably check in the midst of this transaction, and as you can see, this is why I told you this is a lot of stuff we've already talked about, so there's no real need to go into this in depth. Any recent construction, any potential rezoning, any lead-based paint concerns, all of these things are just have it looked at, check if you care, point out the red flags. We also pointed out in the 2T about the due diligence period. Folks, when does the due diligence period run through? Whatever is on the contract is the first part of the answer, but there's another piece that I'm looking for. It's whatever day we negotiate. Not date and time. There was a very standardized time that was on the contract. There you go, Donna. 5 p.m. Whatever date we negotiate, and it runs through 5 p.m. And remember, that was a time is of the essence concept. No wiggle room. Which means if a buyer was to terminate at 4:59 p.m. on their due diligence date, they get their earnest money back. If they terminate at 5:01 p.m. on their due diligence date, they have forfeit their earnest money because now they're outside of their due diligence date. That is a very important understanding there. That it runs through 5 p.m. Time is of the essence, meaning no wiggle room on whatever date you negotiate. Of course, other things that come into play, the title examination. We talked about all the abstract of title, the title search, the chain of title, the North Carolina Marketable Title Act, where they search back 30 years because any lien, any defects older than 30, we extinguish in North Carolina. So only an attorney in North Carolina can do the title search. And of course, they want to make sure that there's no liens that are not going to be satisfied, no title defects that need to be cleared. And of course, if there's any on there, they would need to be cleared as part of closing. And if they can't be cleared, then the seller would be in breach of contract. Another point of clarity here in this closing a real estate transaction section, folks, I told you that the escrow agent could really be anybody. More often than not, the escrow agent, meaning the person who's holding the earnest money, is the attorney who's handling closing. But there's nothing stopping it from being one of the brokerage firms, like the buyer agent firm or the listing firm. It could be either. If it is being held by somebody other than the closing attorney, what we state is that they could transfer that money to the settlement agent within 10 days prior to settlement. They can't transfer it before then, but sometime within 10 days prior to settlement, they will transfer it. Now, let me explain something, and you're not going to have to do the math on this for pre-licensing, but you may have to understand this. Folks, I want you to think about this scenario right here. If the listing firm was holding the earnest money, and let's say the earnest money was $10,000. What we're saying is they could transfer that $10,000 to the attorney handling closing within 10 days of the settlement date. But a lot of times we don't do that, and here's why. If this listing firm was going to get, I don't know, like a $12,000 commission, it doesn't make a whole lot of sense to send them $10,000 only for the attorney to turn around and send you $12,000 back. That's just a lot of moving around of money for no real reason. And so what they'll do in a lot of instances is they will just net it out on the settlement statement or the closing disclosure. Because what normally happens is, let's say there was $12,000 going to the listing firm and $12,000 going to the buyer's firm. Those would both be seller debits, right? Seller debit of $12,000 going to the buyer agent firm, seller debit of $12,000 that's going to go to the listing firm. And so the attorneys would cut a check from the money they take from the seller. So what they do instead is, as opposed to having this money transferred, they will say, okay, well, you've got $10,000 that is the buyer's earnest money, but you're going to be due $12,000. So they say, you just keep that. And what they'll do is when they take $12,000 that would normally be going to the listing firm, they're going to take $10,000 of it, and instead of sending it to the firm, they're going to give it to the buyer to reimburse them their earnest money. And then that way that whenever, it closes, they're going to send the $2,000 that's left to the firm, and they'll have their full commission. They just net it out. So normally, they would take the money from the seller, send it to the brokerage firms. In this instance, they just take the amount of the earnest money and send it to the buyer because it's due to the buyer. It's their money. Remember, earnest money is a single entry buyer credit on the closing disclosure. Who remembers how due diligence shows up on the closing disclosure? If we combine y'all's answers, we've got it. It is a double entry item. So it is a seller debit, buyer credit. We take it back from the seller and give it to the buyer. It's a double entry. It affects both the seller and the buyer at the same time. So seller debit, buyer credit for due diligence, whereas earnest money is a single entry buyer credit only. So understand that there is, of course, that closing disclosure per RESPA, the Real Estate Settlement Procedures Act, that the buyer has to get, or TRID, as it were, the buyer has to get within 3 days prior to settlement to be able to close on time. But there's a separate one that the attorney sends out to us as real estate brokers. It's not the same one, but it should have the same information. And of course, it is our responsibility to help review this settlement statement for accuracy. Bridge, earnest money is a single entry buyer credit. Single entry buyer credit. So it is our responsibility, not just the attorneys, to review the settlement statement for accuracy. And so we would make sure that any credits we negotiated were on there, that the tax prorations were on there, the, escrow, well, anything. Basically, think about it this way, folks. Be very cautious on the test. Are we responsible for reviewing the settlement statement for accuracy of all items? No. All is too much of an absolute. We don't like absolutes. Very rare is the absolute the answer in this class. So we review the settlement statement for accuracy of all items which we would be made aware of, that we are aware of. So first and foremost, if I'm the buyer's agent, I'm not reviewing the seller's stuff, and vice versa. Secondly, even if I'm the listing agent working for the seller, I'm not going to know their loan payoff. I'm not going to know their interim interest, right? There's certain things that I'm not going to know, but I'm going to make sure credits are on there. I'm going to make sure that prorations are right, commissions right, all that stuff. We are responsible for reviewing them for accuracy of all items we are aware of, but not all items. Now, the buyer, of course, has a smattering of different credits and debits, including, as we just said, the due diligence, and the earnest money, because they're already kind of tied up in other places. Sometimes they negotiate credits from the sellers, but they will still have what's called the cash needed to close, or the cash to close as they call it. And that's how much they still need to bring to the transaction in order to buy the house, because there's already some money tied up. And so we're going to say, this is how much left you need to bring. And that does need to be certified funds. Attorneys do not like personal checks. They don't even like cash, although some will accept it. So bank wire, certified checks, things of that nature, certified funds brought to settlement. And of course, the attorney arranges for the title insurance. Remember the different types of insurances that we have. Don't confuse those. Title insurance is that insurance policy on the concept of ownership. And so we said it's a one-time premium paid at closing. There is a lender's policy and a borrower's policy when you're getting a loan, and the borrower pays both. So the title insurance policy for both the lender and the borrower would be buyer debits. Now, as we're talking about settlements, this is not going to be a hugely consequential thing. We keep calling it the settlement meeting in North Carolina. That is sometimes referred to as a face-to-face meeting. Why? Once upon a time, folks, they actually were face-to-face, meaning sellers and buyers sat at the closing table together. And they all passed around the documents in a circle because we wanted 4 copies. And so all parties signed all 4 documents. One copy for the buyers, 1 copy for the sellers, 1 copy for the attorney, 1 copy for the agent, or whatever it may be. And so they stopped doing that because sometimes there's a lot of emotions in real estate and people did not get along as buyers and sellers. They get a little hostile. So we don't really have them sit there anymore. We still call it a face-to-face meeting. But what typically happens is the sellers go first and sign their documents because they have a lot less to sign. And then the buyers will go in after and sign all their documents. And they have a lot more to sign because they have to sign all the lending paperwork that the attorney is handling on behalf of the buyer's lender. So we use the settlement meeting in North Carolina. And the attorney typically handles closing. There are other states that are use what's called an escrow type closing. Think of it more like a mail away. They'll send you your paperwork that you need to sign, and you will go and you'll sign it in front of a notary public, get it notarized, and then you'll overnight it back to the attorney, typically a title company, and they will finalize all the documents and then send everybody their information. So it's not so much that in-person kind of thing, but they both will end up in closing. Now, let me point out one of the more testable items that trips students up on the test all the time. Okay? This top bullet point. When you sell a house and you make money, that does have to be reported to the IRS. That is called a capital gain, because a piece of real estate is a type of investment. And so the attorney is reporting how much you made to the IRS. That is a requirement. And so it would be non-employee compensation. You made it from an investment. And of course, we're going to talk in a little bit about, there are times that you would know taxes on it, but the government still wants to know that you made it, and you could claim a capital gains tax exemption. But let me warn you about where students mess up on the test. If we were to ask a question that says, which of the following is true about a settlement agent in North Carolina? If we said something like, the closing disclosure is recorded, that's not true. The closing disclosure is just, copies are just given to the parties. The deed's recorded, not the closing disclosure. But if we had a statement that said, the settlement agent is going to report the income the seller made to the IRS, that is a true statement. So go ahead and burn that into your brains right now, that is a true statement. The attorney does report the money the seller makes to the IRS. It's just that sometimes they are able to claim a tax exemption, even though it got reported to the IRS. They may not owe taxes on it. And as I said, we'll talk about that in a later section. not that it's super consequential for the sake of your test, but I will clarify something else I said yesterday. Of course, the lender's interest in the closing is being handled by the buyer's attorney, but what I really want to focus on is that bottom one. It says all existing liens to be paid off before title officially transfers. What am I missing with vodka and tequila? What are y'all doing? Oh, gotcha. No, it's actually Fresca. That was a good guess, though. It's Fresca. I figured I needed like some soda because I keep having that tickle in my throat. I'm trying to combat that without having to keep a cough drop in my mouth the entire time. I wish it was something stronger. Yeah, y'all are questionable. Okay. It's a pre-holiday, not an actual holiday. I'm not drinking while I'm Listen, you'd know if I was drinking. It'd be a mess. Okay, that would be real bad. Yeah, that's a good idea, Lisette. I might need to make that on the next break. Here's the clarification that I gave you yesterday. On camera. All existing liens to be paid off before title officially transfers. This is kind of the funny thing, is it all happens at closing, but it doesn't actually all happen at closing because the seller doesn't get their money until the buyer's loan funds it. And so then the attorneys hold all the monies and then they cut out a bunch of checks, folks. Sometimes it's anywhere from like 9 to 30 checks that the attorney has to cut. And that would include, the different brokerage firms. That would include the insurance company. That would include, the bank's escrow account, the seller's payoff. There's a lot of different people they could be cutting checks to. And so even though the seller signs a deed transferring title to the buyer, and then the buyer signs a deed of trust transferring that title to the trustee, what hasn't happened yet is the seller's bank has not recorded the satisfaction of their deed of trust yet. And that will not happen until they are overnighted their money. And so we still record all these new documents, but the satisfaction actually gets recorded after the fact. But once that gets recorded, technically everything is still legally compliant because that returns the ownership back to the seller, which means that when the seller transferred it, it was all fine. So it is kind of weird how it goes. We record all the new stuff, but it hasn't actually happened yet, even though we've recorded it, until we get all that fixed. Nothing too crazy here. Conducting the closing, all parties meet, they sign the documents, how much the seller's going to walk away with, how much the buyer needs to bring. Of course, final review. Like I said, this is the matter of fact side of things with this kind of section. And then, of course, after the settlement, and that's where we told you settlement isn't where it's actually closed. A lot of municipalities, we said in earlier sections of the class, they now have the ability to do e-recording. It used to be once upon a time that the attorneys or the paralegal had to actually drive over to the courthouse after closing to register, record that with the register of deeds. But now they can do e-recording. So they can just notarize it, scan it, and they can record it from their office. And once it records, they can typically have it recorded in about an hour or so after it closes. And that's when they will disperse all the monies. And so they'll cut all the checks. Agents come back and get theirs. And of course, that's where I just told you the cancellation of the seller's liens sometimes could be anywhere from 30 to 60 days post-closing by the time it's overnighted and the other bank, issues that satisfaction and it gets recorded and all these different things. And then the income tax part I already told you about. They are reporting the money that the seller makes to the IRS. Chelsea says, do you have to pay for a virtual closing? Yeah. Because it still had to be orchestrated by an attorney. So you're still going to have attorney fees. And then the digital recording still has a cost. So all of that, it's going to be the same. It's just not going to be in person. Yeah. So here's a question for you. When do the seller and the real estate brokers get paid for the transaction? There you go. After the deed is recorded. After the deed has been recorded. Janet says, as a buyer, do you have to report for taxes? You didn't make any money. You spent money. Why would you report anything?
I mean, will that help?
Will it help?
Like for a buyer, will that help for their taxes?
Yes. We're going to get into that in a later section. There are benefits to real property ownership. And so discount points and interest and real property taxes and stuff are all tax deductible or tax deductions. And so you will get information from the lender on what all you paid to them for that every year. And that is a document you will use if you itemize your deductions to help with your taxes. Yeah. Yeah, in terms of deductions, that's right. So I'm just going to rehash the bigger pieces here, folks. I told you RESPA is also called Regulation X. And remember, RESPA stands for what?
Real Estate Settlement Procedures Act.
There you go. Real Estate Settlement Procedures Act. And so this is always dealing with real estate transactions, more specifically when you are purchasing residential properties and you're borrowing money from a federally backed depository. The other big things we told you it does, aside from requiring certain disclosures so you know the true cost of borrowing money to buy a house, it limits those amounts of escrows the bank can hold. It limits kickbacks from other settlement service providers. And so you've just got to know the big pieces. Are there going to be a crazy amount of questions on RESPA and TEAL and all that jazz? No. But you do need to know, certain aspects of it. Now, we've already talked about, and I don't know to what extent this second bullet point is going to get, but the itemization you're going to see, because we're going to look at a closing disclosure, which is one of the forms that the lenders or the RESPA requires, right? That itemized list of the true cost. And that's what we're going to calculate here in a minute when we're talking about the closing a real estate transaction section. But I don't know that they're going to test you on this. Lenders are required to retain all banking documents for 2 years from transactions. However, North Carolina license law and commission rule dictates that brokers have to retain all records for 3 years from the date of last activity. So we would have to keep our copies of closing disclosures or whatever for 3 years. Banks only have to keep theirs for 2 years. And then, of course, we said kind of the big triggers here. When you apply for a loan that is dealing with RESPA, you have to be given that loan estimate within 3 days of loan application, unless they were going to deny your application. And then we said that denial had to be in writing. Why? Not timestamp. No, we're talking about a denial. We're not talking about the loan estimate. If they're going to deny you, meaning they are not going to give you a loan, there you go, Bree. ECOA, the Equal Credit Opportunity Act. They have to tell you why you were denied, so there is no question about whether it dealt with discrimination or not. That would have been a violation of ECOA, the Equal Credit Opportunity Act. So, 3 business days. Remember, business days for the sake of this TRID rule, RESPA, whatever you want to call it, Mondays through Saturdays. Okay, Mondays through Saturdays. The other thing that I told you could be tested on is whenever you reach out to the lender, they have to provide you with that shopping for your home loan booklet or toolkit is what it's sometimes called. So these are all requirements that you could potentially see show up on the test. So it is 3 business days on the front end when you apply. And then remember, the costs that are controlled by the lender cannot fluctuate from that loan estimate. Other loan costs or other costs that are not controlled by the lender can fluctuate a little bit because they are just estimates. They're not in the control of the lender. So, for example, they may say, well, we estimate attorney fees of $1,000, and then the attorney you pick is $1,200 for, their title search or whatever. That's okay, because it's allowed to fluctuate. And so then the closing disclosure, we showed you yesterday, it looks very similar to the loan estimate, but that is the one that they have to be given. The borrower has to be given 3 business days prior to settlement, otherwise they're not closing on time. Now, as a point of clarity here, folks, it has to go to the borrower themselves. This is not something that the agent stands in the shoes of the borrower for. Remember when we were talking about like acceptance of offers, if we knew we were under contract, this does not work that way. It's not whether or not we've seen the closing disclosure, it's whether or not they've seen it, the buyers. And we said they had to confirm it in order for the days to start counting if they, were sending it digitally or whatever. And then if it was snail mail, it'd have to be 6 days from when it was mailed, 3 days to get there, 3 days for review before it could be considered received. Bree says this is the itemized list, right? Yes, the list of all costs associated with buying the house as they are happening. That's exactly what that is. Now, there are certain things that I talked about yesterday, and I didn't tell you what they were, but here they are, that if they changed to this extent, it would trigger the need for a new closing disclosure and a new 3-day review period. Not all changes dictate that you have to have a new 3-day review period and a new closing disclosure, but there are 3, namely, that would. If the APR, remember that's the annual percentage rate, not just your interest rate, the overall cost association, if it increases more than 1/8% on a fixed rate loan or more than 1/4% on a variable rate loan, they would need to give you a new closing disclosure and a new 3-day period. If a prepayment penalty was added, that would trigger the need for a new closing disclosure and a new 3-day period. And then, of course, if they change the basic loan product. So sometimes you'll apply for conventional, and due to certain reasons or things that happen, you may have to switch to like an FHA to save a deal. And so if you change products like that, that would trigger the need for a new closing disclosure and a new 3-day review period. So let me ask you a couple questions here. This is due to the borrower within 3 business days of loan application. Ashley says law enforcement. No, I'm kidding. Loan estimate. There you go. And this is due to the borrower 3 days before settlement or 6 days if snail mailed. Closing disclosure. There you go. Now, this is just rehashing things that I already said. We are required for reviewing the closing disclosure for accuracy of all items we know. Do not say all items. Be very careful. I told you buyer's agents are not responsible for verifying seller's costs, vice versa, and even within your person, there are certain things we will not know. As a buyer's agent, I'm not going to know their loan cost. I can't verify that. That's between them and the lender. Same thing with the seller's agent. I can't verify their loan payoff. That's between them and the lender. The attorney gets the authority to get that loan payoff, but we do not. So verifying it for accuracy of things that we are aware of, could be aware of, not all things. Always a big caution on the test. Very seldom is the answer ever going to be all. I'm not going to say never. Now, obviously, folks, if we catch a mistake and we don't report it, we could be in trouble for a misrepresentation or an omission. So you would want to make sure that you point out issues. And by the way, issues are common on these closing disclosures. You got to think attorneys' offices are doing thousands of closings a year. It is not uncommon for mistakes, because what will happen is they punch it all into a system. The system kicks out these numbers. And then if a closing date changes, if they don't go in and actually tell the system to recalculate the tax prorations, it won't. So if closing gets delayed by 2 weeks, very often the attorney just leaves it and somebody's paying more taxes or less taxes than they're supposed to because the date changed. They make mistakes quite a bit. So here's where we're going to get into the doozy part of this. Okay. And I've been teaching you this throughout the entire class. So this is not going to be like the first time you've heard this, but I am going to have to show it to you in kind of a more in-depth format. And I will tell you that I'm going to show you the worst format you could possibly ever see, but then I'm going to tell you that it will not look that bad on your test. So, folks, what it comes down to is a settlement statement or closing disclosure, whatever you want to call it. Like, once again, settlement statement is just a generic term. Closing disclosure is the specific one that meets the needs of TRID/RESPA. All it is, as we've stated, is the itemized list of all costs for the buyer and the seller. Total costs are total debits for the buyer, total credits for the buyer, total debits for the seller, total credits for the seller. They both have credits and debits. And so when you take a look at this closing disclosure, you just total up the credits for the buyer and the debits for the buyer, and you find the difference between the two. And for the buyer, that tells you what their cash to close is. How much money do they still need to bring to closing to be able to buy this house? For a seller, when you total up their credits and debits and you subtract them out, that tells you what they're going to walk away with. It's called net to seller or cash due to seller, whatever you want to call it. And so the biggest thing is just dissecting this piece by piece and understanding whose costs are what. The other thing that you have to understand is, does it affect the buyer, the seller, or both? In other words, is it a single entry item or is it a double entry item?